MMTs. This call option, which was a 570 call, when Google was putting the bottoms in over here on the daily chart at 473, you could have been buying $100 up and out of the money. The risk was, MMT, the contracts for 4 cents. Google put in a bottom. It never went to 570. It didn't have to. But it had a bull rally that would generate $100 up and out of the money. These were 4 cents. Google was at a massive low. Google was massively oversold and a low. The combination was perfect. They don't come around all the time, but when they do come around, you can make fortunes. This contract right here, if you bought 100 contracts, you would have had a $400 investment. If you bought 200 contracts, you would have had an $800 investment. They went from 4 pennies on the 570 call. When we put in the massive oversold low, these were as high as $7.30. Your $400 investment would have paid you $70,000. Google's top was 550 from the low of 473 to 550 on the stock chart. It never had to get in the money to make that. We were massively oversold, and we called that bottom. And when that bottom was put in, that bottom up and out of the money was a wonderful place to be. And the next day, these contracts went as high as $1, from 4 cents over here to $1. Then the next day, they went as high as $2. The high was $2.90. You can see down here. Then the next day, they made another high of $3.40. And then finally, when Google got that last big daily breakout on a Thursday, the contracts topped and you sell it. Why? Once again, you were totally inflated. And inflated must be sold, because inflated does not stay inflated. And now they're $2 a contract here. These hit a low of $1.90. Google reports earnings July 14th after the close. Now, let's take a look that this is a 490 put. If Google gaps down $30 or $40, if they guide the quarter down and they've really, popped this thing, Google does trade. I mean, we've been trading it since it's been a publicly traded company. August of 2004. Oh, yeah. And they make this put was so inflated up here at $25 that they finally got it down here to the all-time low. As I said, you can make a premium trade 90 cents. 90 cents. They expire the day after the report. You have very low dollar cost risk capital. And even if you bought 5 puts, and if Google, on the other hand, blows out the quarter, gives an upside guidance, if they are to do that, then these contracts here are going to, they come down here, let's say during the week before the earnings, if they come, they're not going to be 4 cents right away, no. But let's say they come down to 60, 70 cents. For 5 contracts for $300 to that upside gap, 5 contracts just in case they gap it down, depending on what they report, you could be well diversified for the 7/16 options expiration. They expire the next day. Google makes these big moves on, and so expiration 7/16, 7/15 after the close. 14 they report earnings. Once again, it's all about how I could have bought up and out of the money. It never had to go to 570 to make money. Oh, no, no, no. There's nothing wrong when a stock was this massively oversold. It wasn't a gambler's pipe dream. No, it was not. We had reached such an oversold condition that 4 cents was going to go higher in premium. Whether the 4 cents was going to stop over here at $1, or whether it was going to go up to $2.40, it didn't matter. What mattered was the amount of volume that you could have bought for $400. Say they only went to $2 and you sold 100 contracts for $20,000. You just made $19,600 profit. At these major bottoms in the equity. That was the major bottom right here. That was the major bottom there. The 490 put was deep at the time. It was in the money. They took it all out. And this is how these things are going to be traded. Not just with Google, but lots of them during this earnings season. Why do you think we enjoy our life so much, MMTs? Leo, what do you feel about this?
Fairly ecstatic. Can't wait to be in that money.
That's right.
It's a life changer right there.
Well, it is, and that's what options are used for. The best time to buy the biggest moves are when you're so overbought, you got to go down. When you're so oversold, massively oversold on the equity at 473, that's $100 above the strike price that you're buying at 4 pennies over here. 4 cents. They opened at 10 cents that day and they dropped them down to 4 cents, and even if you paid a nickel or 7 cents, it doesn't matter. Your risk is minimized. Does it ever have to go to the strike price, Leo, to make money?
It's not.
No. And it's done with high beta stocks like CMG, like Netflix, like Google, and at times like Apple, and at times like Amazon.com, and other various different times. We will do some more strike prices. I will cap this video here. This is the glory of understanding where market pendulums are deeply. But look at here. Notice how the put options had a low over here on the 490. That low was $4.80 to the top here when they got inflated. That top was $24.60. That's a $20,000 trade there on the put side when Google was getting smashed down to those lows, and then you'd be selling. And at the same time, Transformer came in here. Boom! Nice way to diversify risk. Diversify dollar cost capital risk entries using high beta stocks such as Google, Apple, and many others that we can talk about.